Having heard Mr. M. Murali in the morning, we are still in the real estate world, and real estate, a cornerstone of our economy, is intricately interwoven with income tax regulations.
Real estate transactions, often significant and complex, carry implications that stretch beyond the immediate transaction itself. By delving into various sections of the Income Tax Act, we aim to equip you with the knowledge to navigate the intricacies of real estate taxation, compliance, and the utilization of exemption to your advantage.
Our esteemed panelists will delve into the nuances of this relationship, offering perspectives that are both practical and enlightening.
Without further ado, I request CA Mallika Arjun S., Chairman, Hubli Branch of SIRC, CA Madi Vallappa Tigadi, Bellavi Branch of SIRC of ICAI, to escort our moderator, CA Naveen Khariwal ji, and our esteemed panelists, CA A. Shankar, Senior Advocate, CA Suryanarayana, Senior Advocate, and CA Ashok Raghavan, onto the dais and introduce them by presenting a bouquet.
A huge round of applause to our moderator and the panelists for the day. CA Naveen Khariwal, CA Shankar, and Shri T. Suryanarayana, and CA Ashok Raghavan. I request CA Madivalappa Tigadi, Belagavi Branch Chairman, to introduce our moderator and panelists to the gathering.
It's not audible. Yes. Well, I'm elated and extremely happy to introduce in a row 4 of the luminaries and finest speakers of this country. Well, I know that we don't need an introduction of all these luminaries on the stage, but yet, as a matter of protocol, and at least for me to cherish, I have to do this. Well, I'm extremely happy to introduce our today's moderator of the 7th technical session and panel discussion on the issues of real estate transactions and the searches from the direct tax perspectives, CA Naveen Khariwal sir. Naveen Khariwal sir is a Bachelor of Commerce and fellow member of Chartered Accountancy. Naveen sir comes from the family of Chartered Accountants, totally 3 generations of Chartered Accountants in his family. He was co-opted member of the Direct Tax Committees of ICAI New Delhi. Sir is currently a member of Central Tax Committee of FKCCI and member of Study Circle Group of Committee of Chamber of Tax Consultants, Mumbai. Sir has been a part of Bengaluru branch of SIRC of ICAI and most of the branches of SIRC of ICAI as a speaker, and we have seen him even during the seminars with his greatest argumentative skills. He appeared more than as a chartered accountant, as an advocate, even during the sessions. With this brief introduction, I present before you today's moderator, Mr. Naveen Khariwal, sir. Well, I'm again delighted to introduce the most famous, a chartered accountant turned advocate, and to whom we all look up to, CAA Shankar sir. Shankar sir is a chartered accountant by qualification and a very renowned advocate by profession. He is practicing advocacy for the past 20 years in the Honorable High Court of Karnataka and Honorable Supreme Court of India. He was designated as a senior advocate by the High Court of Karnataka in the year 2018. Before donning the advocate's robes, he was practicing as a chartered accountant for close to 20 years and mainly involved in the representations and litigation matters. He is a gifted orator and has presented a number of papers in various seminars and conferences conducted by ICAI both at regional and national level. He is an expert in search and survey matters, real estate transactions. His penchant for interpretation of statutes has resulted in several landmark cases which have been widely reported in ITR, CTR, DTR, and Taxman, etc. He's extensively involved in wide and varied charitable activities. He's a member of several committees of well-known organizations, associations, and chambers. He's a reservoir of knowledge which he actively passes on to his juniors. A highly respected individual in society known for his affable manner and Shakespearean quotes. With this brief introduction, I present before you A. Shankar sir. Well, I'm again elated to introduce yet another speaker and a senior advocate, Shri T. Suryanarayana. He's a graduate with commerce and law degrees. He's enrolled as an advocate with a bar council in the year 2000. He started his practice with one of the oldest law firms in the country, Messrs. King and Partridge, from the year 2000. He was designated as a senior advocate by the Honorable High Court of Karnataka in the year 2021. He has 23 years of experience to his credit, both direct and indirect taxes litigations. He has vast experience in transfer pricing, international taxation. He also specializes in civil, commercial, and criminal involving economic offenses and arbitration. He appears before the trial courts, tribunals, high courts, and supreme courts. Again, with this brief introduction, I present before you Sri T. Suryanarayana, sir. Thank you, sir. Yes, I'm privileged to introduce the fourth panelist of the session, CA Ashok Raghavan, sir. Sir is a fellow member of Institute of Chartered Accountants of India and a Bachelor of Commerce from Bangalore University. Sir is partner of NCS Raghavan and Co., partnering with Chaudhary and Narayan from Bangalore. And his areas of specialization include property laws, direct taxations, company laws, FEMA, and documentation of various agreements, including foreign collaboration indentures. He has participated in various conferences, seminars, workshops, and organized and has chaired the many technical sessions. He has also been a writer on contemporary matters, including income tax and corporate laws, and auditing published by various organizations. Sir has authored a book on tax audit published by SIRC of ICAI. With this brief introduction, I present before you Chartered Accountant Ashok Raghavan, sir, to you all. And thank you for this opportunity. Thank you all.
Good evening, ladies and gentlemen. My thanks to my chairman, Divya ma'am, and the other 7 branches of Karnataka for having given me this opportunity to have on my panel 2 of the stalwarts of our profession, turned advocates, and Surya sir, who's now been introduced by Mr. Shankar. When I had an opportunity, to deliberate with them, I had asked Shankar sir now, who should be the 3rd person on the panel? And then he gave me an idea, so-and-so person, and because the topic was reassessments, he could not have thought farther than, our Surya sir. So let me begin without much ado. The first question now, how we'll go about it is, Shankar sir will take you through all the provisions of search. Ashok Raghavan sir will be dealing with only, the taxation and issues in immovable properties. And Surya sir will give you, your opinion on new regime of reassessments, the new regime under 148, 149, etc. So coming to the first question for our Shankar sir, this is regarding search and what happens. Normally in Karnataka, in Bangalore, the search happens at between 7:50 to 8:05 a.m. in the morning. So trunk, the officer comes, rings the bell, takes a warrant. Your name will be there, he'll show the warrant, get inside. When they start searching your bedroom, your rooms, first thing which comes out of the cupboard is jewelry. What about gold jewelry now? Now there may be gold jewelry, there may be silver articles, there may be diamonds. So the first issue regarding the gold jewelry, vis-a-vis wealth tax returns, vis-a-vis the board instruction, vis-a-vis the source for the purchase of the gold, vis-a-vis the gold may belong to your grandmother, great-grandfather. 100 years back, I am having this. I don't have any bills today. I don't have any invoices. But this gold jewelry has adorned my cupboard for the last 100 years. It is my ancestral jewelry. It belonged to my grandparents. I cannot prove it though. And there may be other jewelry, for which the period of beyond 10 years, 149 1B, beyond 3 years up to 10 years. So this jewelry is purchased beyond 10 years. In the light of all these issues, as suggested by all the members, my first question to our Shankar sir is with regarding this, the gold jewelry, silver and diamonds which are found in the course of a search. Sir.
Very good evening to one and all. At the very outset, I wish to place on record my deep sense of respect, gratitude to my mentor, Sri Suresh Venkatesan, who has been a pillar of strength in the journey of taxation as far as I am concerned. I bow down to him and my respects to him. He is late. When Naveen came and asked me that I have to answer a set of questions, I told him, I am going to give only one answer throughout. 3 words. Very important. Each of you have to understand, apply, educate your clients, and take forward the process of search. The answer I told him was, I am going to tell him, I don't know. I don't know for every question that he proposes to answer. This is precisely the answer clients must give the officers when they visit their premises and ask them questions. I don't know. As long as I had an experience of handling a matter of extreme importance, having great tax implication, and my then senior and now senior mentor had told the client to tell the search officers, I don't know, I don't remember, I'll explain later. 225 questions were asked and same 3 answers were given. Officer was fed up. He said, why should we come? You are duty bound to come. You have come. You are welcome. You are duty bound to search. Please search. You are duty bound to seize what you feel appropriate. Please seize. And you have one other duty after that. You have to write an appraisal report. All other things you can write in the report. I answered, I don't know. Why do you say I don't know? He asked a very interesting experience by telling, I don't know. I have done this. I am a businessman. Every day I do some 300, 400 transactions. How do you expect me to know all these things? Okay, sir, I will ask you one question. Will you answer that question? Officer interestingly asked, what is that question? What is the breakfast you had on the same day last year? He said, I don't know. Same thing. I don't know what business I did last year. I don't know. You are simply asking me a question, what did I transaction, what is the transaction, is GST voucher is valid, is the purchaser absconding, all these questions, how do I know? I made a transaction, I made a banking payment, and that's all I know. Beyond that, I do not know anything. And simply you are harassing me. You do your search. If you are unhappy with me, please seize all that you feel are correct, and then you do your appraisal report. Coming to the core of the question, in so the jewelry is concerned, jewelry is actually the weakest link for a businessman to yield to the pressures of the revenue officials. The logic and rationality of the same is very simple. in order to succeed in a search, we need 4 pillars to be of assistance. One is the SSC, 2 is the assessing officer, 3 is the SSC's representative, and above all, the 4 is the SSC's wife, if the SSC is a man. The reason is, the pressure that they will put to seize away 5 kgs, 3 kgs, 2 kgs jewelry over a period of time accumulated with sense of pride, satisfaction, concern, diligence by that lady will all be threatened to be taken away, and that is where the pressure starts on the man to say, do something, allow them to leave. Do something, allow them to leave. I know this my grandmother gave on this so-and-so birthday. I was 3 years old. How can these officers come and take it? That is the psychological pressure which the department knows very well. Through the lady of the house, they, in fact, make the man surrender to them by the beginning. As you rightly pointed out, the initial thought in every search is always attacking the jewelry, because India is a country which has probably more gold among the masses than any other country in the world. We have great fascination for gold. Diamonds and things are for a different purpose. Gold is something that all of us have seen right from the smallest of the person, a mason, a housewife, want to have 1 gram gold, 2 gram gold. That's the whole passion. So this gold is something which is very, very, very personal to the Indian system, and that is the weakness there. If you are able to boldly tell them, here is my list, here is my wealth tax return, filed up to so-and-so year, you do what you want. I'll take law in the right stride and I know how to get it back. After all, the lady of the house also knows most of the jewelry has hardly been used. It would not have been used for the last 4 years, safely kept in the safe, but the next 4 years, they don't want it to lie in the income tax safe. As long as they permit it to lie in the income tax safe, your search will become a success. The day you want it in your safe, untouched in your house, the problem arises for the determination of income. The circulars are there which says X amount of jewelry should not be, some 500 grams for a married lady, 250 grams for unmarried, 100 grams for a male. These are all numbers, and there are some few decisions of the Karnataka High Court and other courts which say they should not seize. What happens if they seize it? It amounts, you will say it is an illegal seizure. You will say, I want to take law into my remedy and ask somebody like us to file a writ petition. We will file a writ petition. What are the consequences? You are giving the revenue time to build up a very strong forte, because when you file a writ petition, you are actually giving your defense. And that is precisely what should be avoided at the initial stage of a search, or immediately after the conclusion of the search. Because your defenses are very, very, very powerful, very private, and should be treasured like gold and diamond. They should not be so easily be told to the officers, because once you tell them, they will counter it and write some more complicated. I had the experience of being very fair to them in my initial years of practice. And I found that every time I was fair to them by giving every detail, ultimately the client had to suffer much more than what the best thing would be to say, I don't know. Yeah, as long as you keep saying them, I don't know, at most they will write 10 pages. They will probably levy a 10,000 penalty for non-cooperation. But in the long run, you will succeed much, much easier than in the normal course. Jewelry, now Wealth Tax Act is, now we are dealing in 2023-24 searches in future. Wealth tax is no longer there from the last 10 years. 10 years back, for diverse reasons, most of us would not have filed returns, wealth tax. Can there be a presumption in a case that if you don't file wealth tax returns, I will not take into account? That's what the circular says. In a way, the extent of what is filed in the wealth tax returns, if you do not have any authentic record, those are all not very, very apt insofar as determination of the exact jewelry which is excess is concerned. Ultimately, it will become a matter of, put it in lighter way, negotiation between you and the officer to tell him that these are the bills, these are the check payments, everything is accounted. And ladies have a very, very interesting concept of transformation. Today it will be a bangle, tomorrow it will become a chain, day after tomorrow. They have very fascination to keep going to the jeweler and keep changing. So the bill will be for a necklace, but there will be a bangle lying. No, total grams will tally. The officer will say, no, you have to show a bangle. You have hit somewhere else. Show me that place. So, And they will also add by saying, moment you convert your bangle to a necklace, you have to pay capital gains. You are not paid capital gains. You can't even tell him I converted because you have sold one asset and bought another asset. So it has to be handled carefully, but the board circular is very clear. And one very interesting anecdote I will probably explain to you all on the seizure of gold, which has a very interesting experience, though I was not a party to it. It happened way back in the year 76 or 77, and I had the experience of sharing by my mentor. There was a search in a premise. There was a hotel. One commissioner at about 11:30 in the morning wanted to go to that hotel with his Pomeranian dog, which was promptly denied by the hotel. At 11:30, a search took place. They have with them in their house 3 idols, Krishna, Saraswati, and Lakshmi. Though in 76, the IT officers were not empowered to seize certain type of gold. So immediately there's a gold cell which was coming under the control of the income tax department. So the gold cell was called immediately and the 3 idols were seized from the temple in the premises. As usual, writ petitions were filed, and we had the magnanimity and the thoughtfulness of late Govind Bhatt, who was one of the pioneers in our High Court history to be once a very fair and a very good judge. He called the other side and said, "You have seized 3 idols. The defense given by them is, it was obtained by them in a partition made in 1908. A registered document, fortunately, in that case. So now what is your answer to this?" I think this has been very, and it was been put to your officers. And your officers have behaved very, the taxation part is one thing, the behavioral part is equally important. So they directed that the idols be installed back in the temple with all traditional and Vedic honors, and the prasadam delivered to the court in 48 hours. This was the order, it's one of the pioneers' orders on jewelry. So, to complete it, because I know my friend has a lot of questions, the biggest problem with lawyers is that you give the mic on, they can keep on talking, and then probably not complete his desired portion. I have a word of caution to the friends in my CA fraternity and the advocates, that in respect of jewelry, do not get perturbed by the pressure that they put on the date of search. Give them as much details as possible. If you are not able to really fine-tune the difference, say, "I don't know," heaven will not fall. At most, out of 2 kg jewelry in the house, they will leave as per the statutory and be a little more benevolent based upon what check payment you have made. If you have the albums of your wedding or anything else which can demonstrate that these jewelries were part of the system, show it to them, tell them, "No, I want you to record it." Make sure you record in the statement. Do not sign the statement without they recording your answers. The law on the subject is very clear. They have a right to ask you a question, and you have a duty to answer to the best of your knowledge and belief, and then they have a right to record the same. What recording happens will ultimately decide the fate of jewelry. Thank you.
Thank you, sir. My take-home point for this answer, very beautifully illustrated. If suppose, in the course of search, they were to seize this gold jewelry, etc., which are beyond, say, 6 years, 7 years, etc., as sir has rightly pointed out, if there is a photograph, say it's ancestral gold, how do you prove it is ancestral gold when you have no invoice or bill? So if you have a photograph of your grandmother or grandparents wearing that jewelry, you can prove to the department that this is that many years old. Now coming to Shri Ashok Raghavan, sir, my first question, sir, would be, as your fiefdom, immobile properties, pre-2017 and post-2017. Pre-2017, I am going to joint development agreements. So 247.5, read with 247.6, read with section 53 of Transfer of Property Act 1882, read with section 17, read with section 49(1)A of Registration Act 1908. Now, all of you know Chaturbhuj Dwarkadas Kapadia, and then our Karnataka High Court, Dr. T.K. Dayalu, every one of your client in this auditorium would have received that notice at that time, joint development agreement. So I would like Ashok Raghavan sir to throw light on this. What is the taxability of now JDA pre-2017 and post-2017, sir?
First of all, good evening and thanks for staying back for this session. Divya and members of the managing committee, thanks for inviting me. But my first complaint is I've been precariously placed between two senior advocates. I don't know whether that's by intent or design, but they put me in between two senior advocates. But believe me, as a chartered accountant, I will hold my candle against two well-accomplished and senior advocates of the profession. Shankar, of course, is a CA and advocate and is like a family to me. Having said that, I'll come straight away to the question asked by Naveen Khariwal. He said that all of you probably in this auditorium who have dealt with real estate has always been hounded by this notices, reassessment proceedings on quoting the case of Dr. T.K. Dayalu of the Karnataka High Court. I can tell this with conviction on this floor because I'm one person who doesn't give an ambiguous opinion. Whether my opinion is right or wrong, I give an opinion. And that's been the way I've been built by my late father, N.C.S. Raghavan. My opinion is that the decision of Dr. T.K. Dayalu was flawed from day one. It was an incorrect decision. It was on the wrong interpretation of Section 53A of the Transfer Property Act. If you read, the problem started with the decision of Chaturvuk Dharkas Kapadia and 260 ITR 391 of the Bombay High Court, which was compounded by Dr. T.K. Dayalu of the Karnataka High Court, followed by a plethora of judgments. You had Ved Prakash Rakra, you had Pramila Krishnan, you had H.B. Jairaj, you had Potla Nageshwara, you had Tahir Muhammad Poonawala. There were hundreds of decisions against us. Simple premise. You have allowed the developer to come and take possession. On the same day, there is a transfer under 2-47(5) and 2-47(6) of the Income Tax Act, read with Section 53 of the Transfer Property Act. Therefore, the landowner has to pay capital gains on the same day. With a great deal of joy, I would like to say that in December 2019, the judgment of the Supreme Court came in the case of Sheshasai Steel's ACIT Company Circle 72 Chennai, reported in 423 ITR 46. Why I am saying this with a great deal of joy is, when my late father, Sri N.C.S. Raghavan, wrote an article in the Bangalore branch, which is still part of the publications of the Bangalore branch, he had written it so beautifully that the right given to a developer to enter the property is only a license under a permissive possession as understood under Section 52 of the Easements Act. The possession of a developer is only an occupation of the property under a license. It is not akin to a possession of the nature referred to under Section 53 of the Transfer of Property Act, and therefore 2-47(5) cannot be invoked. This is written in 2007. The books are still there with the Bangalore branch. Why I was so elated, the judgment was given by Rohington Nariman. The words are exactly same. My father may have been prophetic in 2007. Rohington Nariman has stated that the possession of a developer is nothing but a permissive possession, and he is only an occupant for the simple purpose of developing the property. His possession cannot be taken as possession or considered or construed as a possession as understood of the nature referred to under 53 of the Transfer Property Act, read with 2-47(5) and 6. They have also added the words that 53 is a legal concept, and therefore till a legal title passes to the end buyer, the question of 2-47(5) does not apply. So Sheshasai Steels has now, according to me, buried the ghost of Dayalu. Buried the ghost of Dayalu. Following Sheshasai Steels, thanks to people like Shankar, Suryanarayana, etc., there are 5 decisions of the Bangalore tribunal itself now. We have N.A. Harris, we have N.G. Balu Reddy, we have Matikere Ramaya Sitaram, we have K.V. Satish Babu, we have Kola Venkatarama Naidu. All of them quoting Sheshasai Steels, all of them upholding Sheshasai Steels, and 3 of them saying that T.K. Dayalu is no longer good law. So according to me, the ghost of T.K. Dayalu is buried, nothing to worry anymore. It should have been buried long back, it took a few years. That's the only difference. Now, he talked about 2017 prior and post. Of course, jocularly I have to tell people that that introduction was not required for me because Venkat has introduced me 50 times today. Having said that, what is the difference between post-2017 and pre-2017? That difference is only with respect to an individual and a HUF. There is no difference on this aspect of taxation for a LLP or a partnership firm or a company. The difference is only for an individual or a HUF because section 45(5)(a) came to the statute with effect from 1/4/2017. And the moment 45(5)(a) came, I thought my practice is over and closed, because if joint development is not going to be taxed on day one as per Dayalu, then what am I going to fight? How am I going to earn my bread? Fortunately, I found that 45(5)(a) is more troublesome than Dayalu also. That is my opinion. So, post 2017, the law is very clear for an individual or a HUF that they have to follow the deeming fiction created by section 45(5)(a). That is, they have to offer their tax in the year, the landowner has to offer his tax on the developer share of land in the year when the occupancy certificate is received for the project or the first occupation. Because in Bangalore, 95% of the buildings do not have OC. We all know that. So this is as far as post 2017 is concerned. Now pre 2017, I repeat, whether it's a company, whether it's an LLP, whether it's a firm, whether it's an individual or a HF, if you are a simpliciter landowner and you are either entering into if you're entering into an area sharing agreement, the question of you paying tax on day one does not arise post the decision of Sheshasai Steels. This is my submission as far as question number 1 is concerned. Thank you.
Thank you, sir. We'll continue the next round of various issues in 45(5). Now I call upon and request Shri Suryanarayana sir about this reassessment regime, which is applicable from Finance Act 2021, amendment made in Finance Act 2022 regarding meaning of information as per explanation 1. So I request you, sir, to discuss about the term information based on the amendment made in Finance Act of 22 with retrospective effect from Finance Act 21. Only the information as per explanation 1.
Hi, good evening. First of all, let me thank the Bangalore chapter of SIRC headed by Shri, Ms. Divya and her team for inviting me for this panel discussion on interesting subjects of search and seizure, reassessment, and of course, capital gains pertaining to real estate and other issues. As far as this amendments to reassessment, the provisions related to reassessment, virtually these amendments, according to me, this is my personal opinion, this has taken us back to 3 decades, by 3 decades, because the language used now, post-amendment, post the 21 amendment, is what was similar, pre-1989. The word information, if you recollect, I'm sure you are aware, it was there in the 1922 Act, and thereafter, when the 1961 Act came, prior to 1989 Amendment 147 was in 2 parts, 147 1A and 1B. 1B said that the assessing officer has the power to reopen, basis information in his possession if he has reason to believe. One good thing about that era is the phrase reason to believe continued. I mean, it was there. Apart from information in his possession, he also had ought to have reason to believe to reopen. The phrase reason to believe has now been omitted. Now, after omission of reason to believe, what would be the meaning of information? Now, the phrase used is information to suggest. Information which suggests that income has escaped assessment. That's the phrase used under the 21 provisions. Now, information has been defined under explanation to 148. The 21 Act just said information is something that is flagged by the risk management strategy given by the board. Now, 22 amendment removed the word flagged from the first clause and inserted 3 more or 4 more clauses. Basically, they have expanded the scope of information by not just where the assessing officer not just gets information from the risk management strategy. Now, what that risk management strategy itself is not very clear, although the board has issued one instruction basically, which basically says, which is something akin to section 135A. 135A, which is faceless collection of information. Risk management strategy, according to the board, there's an instruction that has been issued, is basically every information pertaining to every SSEs or your disclosure of financial transactions under various provisions, 285A, AB, and all that, whatever information they collect, they put it on a portal, and that information is available to various officers. Now, the word flagged has been removed and 3 more clauses have been inserted. What are those 3 more clauses? 1 is audit objection, 2 is information that you get from from other countries under the DTAs through the competent authorities. And the 4th one is the information that you get from section 135A. Now, I don't see too much of a difference between the information that you get from section 135A, because 135A, if you see, is basically what the board says, that the information that you get under the risk management strategy. So I don't see too much of a difference in the assessing officers collecting information, whether it is under the risk management strategy or under the section 135A, which is faceless collection of information. Now, as you know, faceless collection of information, the provision was also inserted simultaneously in by Finance Act 2021, and the section 135A said that the board shall promulgate a scheme which is called the e-verification scheme, and if you go through the provisions of the scheme, it is basically collection of information from various persons and authorities and putting it on one portal from which the assessing officers pick that information. Now, apart from that, of course, the information can be from by reason of any orders. One more clause that has been inserted is the information can be from any orders passed by appellate authorities or the tribunal. So this is how the scope has now been expanded. Now, some of the things that we will have to be prepared for is 1, information. Now, what is information? Ultimately, we go back to the era of pre-1989 era and see what is information, how the courts have understood information, starting from Supreme Court in Raman and Company under the 1922 Act. Earlier the jurisprudence on the word information was that any information, including the assessing officer getting an information from relook at the records that were in his possession at the time of original assessment, even if there is an error in law or error in fact, could be information, is what the Supreme Court used to say before the 1922 Act was amended in 1947 or so. Thereafter, after the 1961 Act came, because at that time, if I remember right, under the 1922 Act, apart from information, the word disclose also was used in the provision. So basis that, there were various case laws. Now, ultimately, I think to understand what is this information basis which the assessing officer can really reopen an assessment, we have to go back, like I said, to the old judgments pre-1989. And one of the most important judgments is that of the Supreme Court in ALA firm, which basically looks into all the cases, prior to ALA firm, including the most important, your Indian and Eastern Newspaper Society, which somewhat overruled Kalyanji Mavji, and the judgments under the 1922 era also, and says that information can only be new information. It is very important that the information has to be new information. It cannot be information which is already there on record. Because Kalyanji Mavji said information can be something that is there on record also. If an error is made by the officer in not looking at it at the time of original assessment, he can still reopen. Now that part of it was overruled by the Supreme Court subsequently by a larger bench in Indian Eastern Newspaper Society. And that, of course, recently also has been clarified by the Karnataka High Court in Delhi International, overruling its earlier judgment by a division bench in Rinku Chakravarti. So we will have to fall back and see these judgments of the Supreme Courts under the old era of 1922 Act and pre-1961 Act, pre-1989, and understand what is the information. So according to me, to my mind, information still has to be new information. It cannot be information which is already there in the record and which the officer has overlooked or has looked at it and did not do anything about it at the time of original assessment. And that is one part of it. The second part of it is now the expanded definition of information has brought in audit objection. Now, pre-1921 amendment, we have been taking the stand that audit objection cannot be the basis for you to reopen because that would amount to borrowed satisfaction. It cannot fall within the meaning of reason to believe. Because the satisfaction has to be of the officer who is reopening the assessment. He cannot borrow satisfaction from somebody else. There are several judgments of the High Court which have said audit objection cannot be the basis for reopening. Now that kind of goes because of two reasons. One, this specifically says, information specifically says that audit basis and audit objection also, assessment can be reopened, and by the removal of the phrase reason to believe. So that the removal of the phrase reason to believe after the 1921 amendment will have a bearing. So basis any audit objection, the assessing officer can still reopen. So these are some of the issues that may arise because of this expanded definition. I don't think we need to go into really the information that the officer gets through competent authorities under the DTA and through other authorities, through higher authorities. Those I think we can't really question. So this is what I think, there is of course much to discuss information. This is something, can be never ending, this discussion, because it's a new topic. There will be a lot of debate. There will be a lot of, we have seen actually this amendment to reassessment was supposed to be to reduce litigation. But this amendment suddenly has generated so much litigation under the reassessment provisions, especially the writs that are being filed in the High Court. There are hardly every notice, is being challenged in the High Court for some reason or the other, whether it is because there is no information or the information does not fit into, because it is not information relating to an asset, because for various reasons. And of course, the limitation issues are also there. So the object with which this amendment has been brought in and the scope is, as not according to me, I don't know how it will, span out in the future, but the object doesn't seem to have been achieved because earlier provision, at least, for it withstood for 35 years, we were still struggling with it. There is a lot of jurisprudence that has come in, and there were people have understood it, assessees have understood it, assessing officers have understood it, and the litigation actually was reducing. By bringing in this amendment, I think it has led to more litigation, and it has now been more complicated by the Supreme Court judgment in Ashish Agarwal, which again has, given rise to the idea was to not file appeals in 9,000 or 90,000 cases in Supreme Court, but there are, I'm sure, hundreds of appeals files across high courts post Ashish Agarwal because of the way department has understood Ashish Agarwal. So we will, since we have very less time and a lot of questions, I will stop here. We'll discuss the other issues. Thank you so much.
Continuing with the question on real estate, I call upon Shri Ashok Raghavan sir now to deliberate on the very important topic of 45(5)(a). Let me just brief you the section and then he will go into all the issues. So the section as such looks very simple, but there are 3 to 4 issues which I would like sir to deliberate. Because this section has created furor all over India. Section is very simply worded. Notwithstanding anything contained in subsection 1, that is 45(1). 45(5)(a) will override 45(1), where the capital gain arises to an assessee being an individual or HUF. From what? From transfer of a capital asset. What is that capital asset? Being land or building or both, under a specified agreement. Specified agreement means registered agreement. Then the capital gain shall be chargeable to tax. When? It shall be chargeable to tax in the previous year in which the certificate of completion, CC or OC, etc., for the whole or part of the project is issued by the competent authority. And for the purposes of sections 48, the stamp duty value on the date of issue of this completion certificate. Now the problem starts. It says, what is the consideration? Stamp duty value. On what date? On the date of receipt of OC. Of what? Of his share being land or building or both. Of his share being land or building or both in the project, as increased by any consideration received in cash or kind or, your check. The question therefore is, the first question is, 45(5)(a), why wasn't it made applicable to other assessees, sir? Why? What is the logic of the government? Why you are telling only individual and HUF? Second issue is of his share of being land or building. Many of the chartered accountants or advocates all over India, they have different opinions. Of his share means, there is a developer and there is a landowner. I have given you my land for development. You are going to give me constructed area, basically. It's not a revenue sharing, it is a area sharing agreement. You are going to give me the constructed area in future. When you give me constructed area in future, whole issue arises is of his share being land or building. I haven't given you the land. I have given you the land for what? Only for development. So on what should I pay tax? Only the SDV or stamp duty value of the constructed area which I have received. I am not going to pay tax on the land, of his share of land. Land I have never given to you. So that is one more issue I would like him to deliberate. And again, what about exemption to be claimed under 54, 54F, 54EC, etc.? Because I am receiving advance over a period of time. Say, the JDA is entered today, development agreement entered today. Over a period of 3-4 years, OC will come after 5 years. So throughout the period of 5 years, I have received advances for my share of land or building. So that 54, 54F, what is the date of investment? You know the time period, 1 year before or 2 years after or within 3 years from the date of transfer. So here is the third issue which would like Ashok sir to deliberate. Sir.
Thanks, Naveen. You have already answered 2-3 of the questions. And before I get to this question, in his inimitable style, Shankar immediately pointed out, Ashok, you gave all the funda about, Sheshai Steels. But there's a decision of the Karnataka High Court itself saying the same thing, that Sheshai Steels is the rule of law today. And he gave it in a matter of 5 minutes from his phone to my phone. Decision in the case of Margaret Govardhan, 10/1/2023 of the Karnataka High Court, upholding the principles laid out in the Sheshai Steels and rejecting Dayalu. So we got Karnataka High Court itself in our favor. Give it to Shankar to me while we were sitting in a chair there. So that is added to the strength against Dr. T.K. Dayalu's decision. Now coming to 45(5)(a), like Naveen said, it's half a page. The section is only half a page. And when it came, I literally thought my practice is going to dwindle down because there'll be no litigation on this development agreement business. Now what do I do from tomorrow? Little till I realized that my practice is only going to increase because of that particular section. Why? First of all, let me lay down my reading of the section and my clear view on the section. One, it applies only to an individual or a HUF, a landowner being a person who's an individual or a HUF. Point one. Second, it applies only to an area sharing agreement and not to a revenue sharing arrangement. That's because of the definition of the term specified agreement given in the section itself. I repeat, it applies only to an area sharing agreement. It doesn't apply to a revenue sharing arrangement. Third, the amendment has been brought in such a way that it supports the contention of Dayalu and Chaturbhuj Dwarkas Kapadia by intelligently putting the words in such a way that the date of entering into the definitive agreement or the specified agreement is the date of transfer. Only the capital gain is postponed to the year in which the OC is received. I repeat, the wordings of the section clearly indicate that transfer takes place on the date of signing the specified agreement. It is only the payment of capital gain which is postponed to the date of receipt of the occupancy certificate. If that view of mine is correct, then your 54F, 54, 54EC, whatever it is, the trigger point, starting point starts from the date of the agreement and not from the date of payment of capital gains. So if you're going to advise the landowners, anyway capital gain is going to be paid at the time of OC. From there you've got 6 months to invest in bonds. From there you've got 3 years to build a house. From there you've got 2 years to buy a house. You are wrong because the section clearly says the transfer has already taken place on the date of signing the agreement. So you should be very careful about that. Next, on 45(5)(a), he asked me a very pertinent question. Why was it applicable only to an individual or HF? Why didn't they open it out to everybody? Now, I'm not the person who grandfathered the amendment. It must be somebody sitting in the North Block. But the fact remains that probably, I'm just presuming, that they felt that a company, LLP or a partnership will always have a land which is in the nature of a stock in trade, because the memorandum of the company will say real estate development, the LLP agreement, the objects will say real estate development, and the firm will also say real estate development. Therefore, they presumed that it will be stock in trade in the hands of these three entities as landowners, and therefore we need not give them the benefit of 45(5)(a). But the fact remains, there are so many companies, so many LLPs and so many firms. For example, I was running a factory. My factory closed down due to fate. Now the asset I'm selling is land and building. Now can I say that it is stock in trade? The answer is no. It is clearly a capital asset. So such cases, unfortunately, 45(5)(a) doesn't apply. We have to go back to the old regime. We have to fight as per as per the latest decision of the Karnataka High Court and the decision of Sheshai Steels, that there is no transfer. We will pay capital gain in such cases only in the year when my risks and rewards, the ownership of the land, get transferred. It's got nothing to do with your occupancy certificate in the case of a LLP company or a partnership firm. I'm very clear about that. So 45(5)(a) in a way is not applicable, and that's a good thing. It is why it is not applicable. Because Naveen has raised one more very important point. What is the deemed value of consideration for the purpose of transfer? Now the section on a prima facie reading says that the deemed value of consideration for the purpose of transfer is the land or building which the landowner receives in return for giving up his land. So an interpretation has been going around the professional circles, even by very learned speakers, that you have to first deem that you have transferred both your land and the building to the developer and received that land and building back from the developer. That is the type of a completely, in my opinion, not being disrespectful, preposterous view. The view is, like Naveen said, the landowner has transferred only his land equal to the developer share which he is going to convey in future to the developer or his nominees. What he gets in return is only the building. Now, question of him paying land and building doesn't arise. He has to pay it only on the building. Now, on what value? They say guideline value. Can you find out a guideline value of only a building? In the Stamp Act, if you look at the columns, you will have one for land, you have to add 45%, 55% for converted land, etc., etc. You will have project-wise, you will have Brigade Panorama, RMZ Latitude, you will have project-wise entries, and you don't have an entry only for the guideline value of the building. So the other day, we had to file a very big return in the month of July. So we went through a formula. We took the FSI, the constructed area and the property. We divided that FSI on what has been quoted for a nearby project. We came and interpolated that to find out what is going to be the guideline value of the land. The balancing figure became the guideline value of the building. And to our surprise, we found that the certificate given by the builder on cost of construction almost matched with that guideline value. So you have to do that work in order to get the guideline value of building and find out how to arrive at a guideline value. But the fact remains that for the purpose of transfer, the deemed value of consideration is only the guideline value of the building. It is not the guideline value of the land and building. That situation doesn't arise. Venkat had some point.
Ashok, it's like this. Why should you not take the valuation as the price on the launch date? One option. Second option, cost plus 10% is what we follow for the purpose of allied
GST.
loss. For the purpose of allied loss. Now third, complications arise when you add TDR to it. Correct? Then how do you go through this valuation? Because that will also have an impact insofar as works contractors services are concerned under the GST law. So I don't think your way of looking at valuation for the purpose of Income Tax Act can be dovetailed along with what is there under GST.
Perfect, Venkat. I'm glad you came up with this counter. Please understand that 45(5)(a) is a deeming fiction created under the Income Tax Act. It's a deeming fiction. The deemed value of consideration is decided by that section itself, saying that it's the guideline value of land and building which comes to me in return. So I don't have the option of cost plus 10% under Rule 30 of the GST rules. I don't have the concept of a Section 50D in the case of an individual or a HUF. I don't have the liberty of taking the cost of construction as my replacement cost under the explicit wordings of 45(5)(a), because the wording says the deemed value of transfer is the deemed value of the guideline value of the building I get in return. Unfortunately, they have arrested the wording. Now, again, Mr. Shankar will certainly elaborate on this. Earlier, what we used to do, we had two methods. Either we used to pay tax on the land given up by adopting 50D, or we used to take the cost of construction, a certificate from the builder, and on that we used to pay tax. On that also successfully contested by people like Shankar in the High Court. They said whatever certificate given by the builder is not sacrosanct. I am not going to adopt that value. The builder will be adding his marketing cost, his office boy salary, his driver salary, his all other things in that particular cost. I have to take what is the cost only of the lime, brick and mortar, which is actually embedded in my share of construction. Kivaraj Motors, Ved Prakash Rakra, he knows that very well. So therefore, those contentions are still possible in the case of a firm, LLP and company. But in the case of an individual or HUF, the deeming fiction under 45(5)(a) unfortunately arrests that option. So I just want to, last on 45(5)(a), whether it's prospective or retrospective. The answer is, there are two tribunal decisions till date, saying that 45(5)(a) is only prospective. Even theoretically so, it applies only to an agreement, that is specified agreement which is entered on or after 1/4/2017. So for all intents and purposes, in my view, 45(5)(a) should be only prospective. Thank you.
Thank you, sir. So to add on, yesterday, you know, the movie Jailer released. And the show started as early as 6:30 in the morning. As our Talevar Rajnikant was back after 2 years. Similarly, according to me, Talevar of our fraternity, Shri Shankar is back after 2 years on the stage. So we are not going to let go the opportunity to take as much as knowledge judiciously, you know, as much as possible. Let us take all the knowledge from him. So before proceeding further with the question, I request you, sir, to throw some more light on 45(5)(a). What do you feel, since he's arguing many matters in Karnataka High Court, matters are all sub judice as of now. I would like to throw some more light, sir, to what Ashok sir has told.
My friend Naveen is behaving like an income tax officer. He told me he will not ask any questions other than search. Come and answer 3 questions and go. Now he wants me to supplement something else. Of course, he took my permission. Apart from the subject of taxation, which I love most, I probably breathe taxation every day. The one other subject which I probably like most, which I always said a few words whenever I come before you all and stood before you all, is little of English poetry. So, in the context of this question, it's very apt to recall the few lines from one of the most brilliant epics of William Shakespeare, that is Julius Caesar, where Mark Antony said, I speak not disprove what Brutus spoke, but here am I to speak what I do know. We all love him once, not without cause. What cause withholds us to mourn for him? So I am not here to disprove what Ashok spoke, but here am I to speak what I do know. Maybe I differ from him on certain aspects for the enlightened audience. Point number 1, insofar as the interpretation of that a transfer has taken place and the capital gains is to be computed at a future point of time, is something would be very difficult to sustain on account of 3 reasons. Reason number 1, if you all were to read the section 45.1, which is the main charging sections for capital gains, the language used is as follows, which I will read for your benefit. Any profit or gains arising from the transfer of a capital asset effected in the previous year shall, as otherwise provided in section dash 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 dash, shall be chargeable to income tax under the head capital gains and shall be deemed to be the income of the previous year in which the transfer took place. So, section 45.1 contemplates a situation of transfer and a deeming at which point of time it has to happen. 45.5a, capital gains section itself by and large deeming in view of 45.1, settled position of law right from ages, which I offhand do not recall those decisions. It is deemed, it's a deemed income, otherwise it was a capital receipt not liable for tax. If you read 45.5a, what it says is, it takes away the right of being taxed in the previous year and deems some other period as a period of taxation. Notwithstanding anything contained in subsection 1, where a specified person receives during the previous year any money or capital asset or both from a specified entity, sorry, I'm reading 4, the 5a would read, notwithstanding anything contained in subsection 1, where the capital gain arises to an assessee being an individual or independent family, from the transfer of a capital asset being land or building or both under a specified agreement, the capital gain shall be chargeable to income tax as income of the previous year in which the certificate of completion for the whole. That means 45.1 deems the previous year. Here, previous year is defined under section 3 of the Income Tax Act to be 1 year before the assessment year. But it makes a marked difference in 45A to say it is the previous year in which a competent authority gives a completion certificate. Occupancy certificate is a very, very loosely worded term which we practicing people use. There is a concept called completion certificate under the scheme of the power to sanction the plans under the Karnataka, as well as Karnataka Municipality Acts, the BBMP rules, as a completion certificate. The law says the building is complete in respect of a position when an architect gives a certificate as completion and the same is filed before the authorities to seek a completion certificate, and if the concerned authority do not give the certificate in a period of 60 days, it is deemed to have been granted. Now this position was taken by us in a very interesting decision known as Mahavir Tuscan, and then the Karnataka High Court was pleased to accept our contention that there is nothing called occupancy certificate under the scheme of the Act. Though it was in the context of little 80 exemption provisions, the parity can be drawn here for the simple purpose the law contemplates a completion certificate, and the statute of most states which permit land laws for development contemplate a certificate to be given by an architect. And so to say that the certificate may not come 5 years, 8 years may not be a reality because the language used is a completion certificate, under the laws under which a building is evolved or developed is the law of the Karnataka, as far as Karnataka is concerned, the corporation, the Karnataka Municipal Corporation Act read with the BBMP rules are the one which permits you to construct in Bangalore. So consequently, similarly there is Huda, there is Muda, there is Gulbarga, all from the state have the respective authorities which control the developmental plans given, and every one of those laws contain a completion certificate, and that completion certificate can be considered. To take a view of what Mr. Naveen was saying, that how do you decide when to invest the money if the transfer takes place in 1 year, and when are we supposed to make the investment? It is one of the most difficult questions to answer. But my view, which I am been implementing, is the question of investing the money unless there is a transfer does not arise. The transfer takes place on a very specified day as per 45(5)(a). That is on the day the completion certificate given. This is only for individuals and HUFs. So on that day the transfer takes place. And if you were to look at section 54, 54F and EC, they also use the word transfer, and that is the cutoff date. Without a transfer, there is no capital gains, and without capital gains being chargeable to tax, the question of making payment as and when you get advance does not arise. In my view, it's a question of either of them can be right. You decide to put the money in another building as and when it came because you thought the transfer is complete. The department will say, sorry, transfer itself is not complete, so I will not give you the benefit of section 54F or 54 for the purpose of reinvestment. If you don't invest, they say, no, you received the money earlier. And this is going to be one of the most interesting litigations that are going to evolve over a period of time. Of course, we being part of the profession, in lighter vein, we have to allow department to take such positions, because if they don't take positions, we are not there at all. Annadata Sukhi Bhava. Coming to the other aspect regarding valuation, my friend referred to the decision of the Courage Motors and Ved Prakash Ragra. There is a very more interesting decision of the Karnataka High Court in the case of Shankar Vittal Motor Company. The concept is very simple. How do you value something abstract? Builders, the Karnataka High Court has specifically negated it on 3 grounds, namely 2 grounds which are evolved and explained by Ashok Raghavan, have been very nicely and succinctly reiterated in the decision, and added one more on the basis that for the purpose of determining the taxability of the developer, he is bound to take decisions that are convenient to him in law. He has a ATI project. He has a project which he has to pay tax. There will be a proper advice of allocation. John Brown said, you need not allocate overheads. So the method of how he allocates the cost is one way. And the second allocation is what probably GST Venkat was telling you all in the afternoon, saying that there are a lot of times when bills itself are not in a very genuine way. To reduce cost, he'll probably put a few bills, and which probably decreases his profit. So, and increases his cost. And if that cost, which is not genuine and correct, is to be adopted in the landowner's hand, it will be travesty of the computation of income in terms of what is known as a real income theory. We have to be taxed on the real income and not on some artificial income, which we probably get by way of a bookkeeping entries. So consequently, my submission is that we have to appreciate the difficulty of the officer. We have to give them the details. And as on today, as the law I interpret, the developer's letter has absolutely zero significance. In my opinion, what you have to take is the guideline value of the building and not the land. Now, Naveen was asking me another interesting question. Why is the land word used there? Probably the only way I can answer that question for the benefit of this elite audience is that development agreements take place in several manners. I have occasion to evaluate a development agreement of developing 50 acres into plotted development, in which I get land only and nothing building. So these sort of development agreements are already in the market, and probably the department is aware. That is why they specifically use the word land and building or both. So maybe a situation may arise where you give 50 acres of development for plotted development. In that case, you will be able to get land only and how to value the land. There may be a case where you give plotted development and get back villas, that is land and building, so land and building will come. And the third option, or building alone, you just give land in central business district and get only building. So all three aspects will come into picture. Reading the decision of the Karnataka High Court and Shankar Motor Company will probably elucidate you all in a much better manner. This is precisely what I would like to add. Yes, sir. Probably you're looking at GST. Under the Income Tax Act, there's nothing called 10%. As far as the income tax is concerned, it is the guideline value on the date of transfer. And a very interesting thing will happen. Not many people understand why this 5A can also act as a double-edged sword and against SSC. Like for example, the commercials that have been decided between the landowner and the developer are based on a particular date of agreement. Now the project is completed after 5 years, and on that day, what would be the guidance value? But this problem will arise in respect of people who want to retain the property, in respect of persons who wanting to sell the property. This will not have a great impact, because when a person in a development agreement wants to sell the property, there are two stages of capital gains. Stage one is that when he has to pay tax on the deemed consideration in terms of 45(5)(a). I am taking to a position after 17. Prior to 17 I don't intend addressing. So he has to pay tax on capital gains, stage one. Second, the property which he obtained will be what is sold by him after a few years, few months. So that will be stage two capital gains. The problem is, a person who wants to sell it away will not have a problem, because what is valued in stage one will automatically be allowed in stage two, and consequently there won't be a tax impact. To give a simple example to make easier understanding, a person has 10,000 square feet of land, he gives to joint development and gets overall building is 20,000, each of them share 50%, that is 10,000 each. There are two stages. At one stage, the landowner parts with his 5,000 square feet, that is 50% of his land, and gets 10,000 square feet of building. There are two things that he can do. On the 5,000 square feet of land which is parted with to the developer, provisions of 45(5)(a) will spring up, and the date transfer tax liability will come. Once the building comes to the landowner, he has his balance 5,000, on that the 10,000 square feet of building. The transfer of this will arise when he makes a transfer of them. So when he makes a transfer of them, the cost of building will be equal to what the department tax. It will become revenue neutral, and there will not be great amount of litigation. The only problem probably we'll find at the second stage is what is short term and what is long term. The point is, I got land which is probably ancestral, probably 20 years old, 30 years old. Now the building has come to me just a few months back after I sell. So that is why, being taxation advisors, we need to imply and implore the civil lawyers who make this documentation to make the consideration in respect of the assessee share of property sold into two ways, meaning there should be land value separate and the building value separate. So naturally, as a consequence, the land value of the owner's share in respect of the property we received will be treated as long term, and in respect of the building which is sold within 3 months of the receipt, short term. For this, there are several authorities, including the Karnataka High Court, I think way back in Subramaniam 242 ITR, memory is right, Citibank in Bombay, Ramchandran. There are a number of decisions that you are entitled to. But if you put it lump sum, again there will be a question of how do you value them. So the most fair method would be is to make a sale deed when you sell the owner's share of the flat, which includes an undivided interest in the land and the building, to clearly demark the consideration what is attributable to land and what is attributable to the building. The two subjects I love most, one is search and seizure, another is joint developments. Sorry for having taken a very long time to answer a very simple question.
Thank you, sir. In connection with the same section, as I've received some questions from the Mafusil areas also, I would like Ashok sir and Shankar sir to jointly deliberate on this very important question. There are two questions now. One is, what question I have received is BDA land, lease. You have taken the land on lease. There is a lease cum sale agreement. and for the period of holding, how to calculate short term and how to calculate long term. That is one question which arises in the mind of professional. And then one more question I would like to raise to both of them. First, Ashok sir can deliberate and then Shankar sir can add to it. Very important case law which both of them fought together. Ashok sir's office case referred to Shankar sir. He fought in tribunal on Trishul Buildtech Private Limited. 115-page order. If you see what was the 3:30, they were searched. 3:30 in the night, Mr. Ashok Raghavan was woken up from his slumber, deep slumber. He was unwell, he had fever. Department had summoned him, hey, come over, we have doubts karke. And he went there. What was it? There is a land builder, and there is a builder, and there is a developer, and there is a landowner. So department is taking that stand, Just because the builder is paying tax based on percentage of completion method, you too as a landowner, you also pay tax on percentage of completion method. You read that 115-page, you will really enjoy. It's a treatise. How to consider what is percentage completion method, what about AS7, what about AS9, and what is completion method, what is the concept of double taxation, considering Bachulal Kapoor, etc. 115-page. I would like him to, cover that judgment also, so that many aspects of real estate would be covered. Sir.
Yeah, two interesting questions. See, the beauty about a panel discussion is there are certain times you have to agree to disagree. So it's very difficult to disagree with Shankar sir, because next day morning at 6 o'clock I'll get a call as to why I was wrong. So it's going to be difficult. But I just want to put in one point with what he said about transfer. My problem with 45(5)(a) is the word which is used, because it's a deeming fiction. It says where the capital asset arises to an assessee being an individual or HUF from the transfer of a capital asset being land or building or both under a specified agreement. And specified agreement refers to an area sharing development agreement. So they are saying the transfer is under a specified agreement. Therefore, they are trying to support Dayalo's view and support the Chaturbhuj Dwarkadas Kapadia view, is the intent of what they were trying to do. So that's what I'm saying. So I just want to bring the wordings of this section. Now coming back to two more questions which Naveen had put in. In the case of a BDA property or a KIDB property, where you have a lease cum sale agreement, which ultimately becomes a sale deed on the performance of certain conditions by the lessee, what is the period of holding? Now in this regard, you all remember there was the decision of Dr. V.V. Modi of the Karnataka High Court, 218 ITR page 1, if my memory serves me right. And under that decision, they held that the period of lease should be completely ignored. It's only when that person gets the sale deed, your period of holding commences from that date, and therefore, if you have sold your lease cum sale asset which has been converted to a sale deed, immediately after getting the sale deed, it's a short-term capital gain, and the entire lease period is to be ignored. So this was a very troublesome decision. But we fought that successfully, and in our own office case, which my late father had done in the initial levels, and successfully so, there was an unreported judgment of the Karnataka High Court. CIT Central Circle, DCIT Central Circle, that was Dr. Shakuntala in 2007, which was argued by an advocate who was right above Mr. Venkateshan, my uncle's office. I don't remember his name, in SNS Plaza. So my... No. There was one day, I'll get you the name. So my father wrote the entire thing of arguments and said, this is what I want to argue in the High Court. And to our luck, they in that judgment, they negated V.V. Modi and said V.V. Modi is not good law. After that judgment in the case of Shakuntala, we have got cases CIT versus Suresh Rao, reported in 41taxman.com 475. We have got Srimati Rama Rani Kalia of the Allahabad High Court in 358 ITR 499. All of this have now clearly distinguished V.V. Modi and said, for the purpose of period of holding, it is the day when you have got the lease and not when the day you got the sale deed, which should be taken for the purpose of looking at the period of holding. Now, if you look at the explanation to 242A of the Income Tax Act also, it says, for the purpose of indexation, the period from which the asset was held by the assessee. So, asset was always held by the assessee from day one. So, that is the date which has to be reckoned. So, in my opinion, nothing to worry. The date of the original lease deed will start as the date of for the purpose of computation of capital gain and indexation, as the case may be. Now coming very quickly to the case of Trishul Biltech, here I want Mr. Shankar sir's interference at the right point of time. This is one of, I would say, monumental cases I have personally fought with a lot of passion, culminated by successful argument of Mr. A. Shankar in the Bangalore tribunal. What was the case? They searched the landowner, and as rightly pointed out, I was called in the middle of the night by the officers. They said, how can you have 650 crores liability lying as advance, which is a revenue share received from a developer as a liability? You have not paid tax for the last 5 years. On the fact that you're showing it as a liability, you have not shown that as an income. This ought to have been shown as an income in a similar way the builder has shown, and therefore I have to tax you. I vehemently argued in the middle of the night. I said, there's no way I'm going to be taxed. I will be taxed only when my risks and rewards of ownership get transferred to the end buyers of units in the project. So this went on and on. We agreed to disagree. Then came the assessment. We filed returns in response to 153A. We filed the returns under that particular section, and they added back. At that point of time, we had got about 670 crores of advance. The total was 1,100 crores of my client, who is the landowner. It was a revenue sharing agreement, not an area sharing agreement. They taxed us on the same basis, saying that the builder has opted for the percentage of completion method. So you as a landowner, you cannot postpone your tax by showing it as an advance. You also should offer it in the basis of the percentage of completion method. So we vehemently argued, and we said, the question of a percentage of completion method applying for a landowner does not arise. ICDS 3 doesn't apply to a landowner. AS 7 doesn't apply to a landowner. AS 9 also, in my opinion, applies to a landowner, but people were always getting confused. And this is where I went to Shankar sir's office and we had a minor argument on that. I said, Shankar sir, neither AS 7, neither the percentage of completion, neither completed contract method applies in my case. Both apply only to a builder or a contractor. I am applying a simple theory of risks and rewards of ownership, which comes under AS 9. People are getting confused. Under completed contract method, Karnataka High Court has given so many decisions in my favor, and therefore I can postpone my tax. I told Shankar sir, no sir, I am not getting into completed contract method, because that is also under AS 7. That doesn't apply to me at the threshold. My simple application is I am a landowner, I am not a developer, and therefore as and when the units are sold in the project, only in that day I will offer my revenue proportionate to the number of units for which possession has been given or sale deed has been executed. And now, brilliantly, obviously argued by Shankar sir in the tribunal, we managed to get a 115-page judgment upholding our view that the method followed by a builder need not be followed by a landowner. The landowner has to offer tax only in the year when the risks and rewards of ownership are transferred. And in that way, we have managed to postpone tax, which the man would have paid 5 years earlier, he paid 5 years later. So the cost of capital, the interest was our fees, basically. So that's how it is. So what I said is, this is a test case for us to prove that we all get completely always, I would say psyched or overawed by these accounting standards and ICDS and 145(1)(2). Go back to the basic principles. What I write in my development agreements, which I draft almost every day, in the case of a revenue sharing agreement, I put a simple, beautiful line. The landowner's share of revenue is in essence for transfer of right, title and interest in the building. The developer's share of revenue is in essence for transfer of right, title and interest in the super built area. And because Venkat will agree with my view, who collects the GST in this case? It is only the builder who collects the GST. Because the builder is the one who is doing the service of building construction services. Landowner does not register for GST, neither he pays GST. Therefore, in my opinion, don't get scared. If you're a landowner and you're having a revenue sharing agreement and you put some explicit words in your agreement, in the agreement of Trishul, which has been quoted by the tribunal, it's also mentioned by me. Some forethought was there in those days when I drafted, to say that the possession given to a developer is only a permissive possession, is only a license as understood under 52 of the Easement Act. the legal domain, control and possession remains with the owner till such units are transferred to the ultimate buyer. The same paragraph has been quoted by the tribunal when they gave that decision, which successfully argued by Shankar sir. So on this matter, I would also request Shankar sir to give his view, because he was the one who handled the case at the tribunal.
For a change, I have no comments. As far as the first question, what is the first question? Modi, period of holding. That is settled position of law now. After the decision of the Supreme Court in 226 ITR Poddar Cements, what exactly is the meaning of possession? What exactly it is? It's more or less settled, and I don't think so. For a 218 ITR was Modi. Shakuntala came a few years later. There's one decision of the Karnataka High Court in Ramchandran, and so many other decisions to follow. We all have to be thankful to the North Bloc that they have not made a retrospective amendment or a prospective amendment in respect of the same. So as long as the law doesn't change, we take advantage that the possession date of the BDL land is the date on which you acquired, and you can take indexation and compute long-term capital gains from that date. There is no quarrel on it. Insofar as Trishul Build Tech case is concerned, at the outset, I would request you all not to follow it, though I have succeeded. See, decisions of the tribunal are at the very initial stage of judicial interpretation. Well-written order. My friend Ashok, in his exuberance, wants us to follow it. My suggestion to that is, if we are able to address the issue of computation of capital gains in a manner that will be comfortable to the respective assessees, please apply that formula. I have one argued interesting propositions, but we all have to understand there are two more layers of litigation on that. And in my experience of life, being a professional, so many cases which we think are open-shut case will have its own fate when it goes to the higher forums. So it's too premature to evolve a position that a landowner cannot, should not apply either percentage or completed contract. That's a contention taken, successful at this point of time. Well-written judgment. Hopefully we'll be able to defend it at the High Court and leave its fate to Supreme Court later. A word of caution, each case goes on the facts. Venkat had asked me in the afternoon to explain some 4 different types of facts. I don't know, I don't recall anything popping up here, but he said, in this computation which you all are looking at for a development agreement, you have to look at the facts of each case. Each case, how the document has been drafted. Permissive, Dayalu was basically a case where there was an affidavit given for possession, so Dayalu is a case which has to be kept in a very different. Dayalu is in Supreme Court SLP pending. For all you know, Dayalu, they may succeed on the point as far as that case is concerned. The revenue may still succeed because there is an admitted fact that possession has been given by way of an affidavit. That is the reason why the case probably went in another way. That is not something, the revenue misinterpreted Dayalu by ignoring one very interesting para in the judgment. If you all take the judgment and read minutely the last 3, 4, 5 paras, these things are very, very evident. The concept of taking percentage or completion method is going to be a long drawn litigation, and over a period of years, what is it for landowner, what is it for developer will evolve. I'll give one simple thing. My friend Ashok also brought your reference edition of the Karnataka High Court in Margaret Govardhan. That case followed Sheshai and also did not follow Dayalu because of the language it was drafted. It was drafted by some civil lawyer. It is something which we argued in our office. The very interesting para that was written, if my memory is right, which has been reproduced in the judgment, is that normally, along with the development, power of attorney is given. The express statement in the contract between the parties is that the developer cannot use the power of attorney till the building is complete. That is precisely the clause which was taken by the High Court and said, you are saying he has a right to transfer. Contractually, the right to transfer has been given him on a particular date, and you can't tax him on an anterior date. On that ground, that decision happened. So, coming to percentage, Trishul, please look at the facts of each case, volume of numbers, and volume, the quantum of liability. Venkat also said in the afternoon that you keep on taking adjournments, you will succeed. So, I should, though off the record of the question, need to elaborate a little for the convenience of the audience. Very fair enough. You have to take adjournment. Adjournment is your birthright. You should not write detailed adjournment like what you told the audience. You must write an adjournment which will confuse you yourself. If you write a very good adjournment, then they will ask you more evidence for it. The case of adjournment, which my friend was referring to, was a 263 order way back in the year late 90s or early 2000. Tribunal decided the case in 2005 or 6. Revenue filed an appeal in the High Court. As usual, there were long days these days. The first time the case was listed was somewhere in 2011. Came before a very eminent judge who had given me a lot of reliefs. And unfortunately, the case was the brother of the former Chief Justice of India. It's a very difficult situation I was in, whether to tell the court who the assessee is or allow to get a relief on the merit of the matter. After half an hour, I came to realize the judge was not inclined to give relief. He was castigating the tribunal and said, this order is unsustainable in law. I am going to reverse it. Thanks to our office having large number of cases, I pleaded with him by saying, lot of research required, may I seek indulgence of 2 weeks' time. He said, no, Shankar, this is not a case, whether 2 weeks or 20 weeks or 2 years. The destiny is the same, the appeal of the department has to be allowed. He said, still, my lord, what has waited from 2005 to 2013 or 12 can wait 2 more weeks. What is wrong in it? After all, some law may evolve by the Supreme Court, which may all be bound. So he said, okay, 2 weeks. Then the next part I can't tell you all in open forum. Privately you all come, I'll tell you all. So the matter surfaced after 2 years. If you all can understand that, well and good. It came before another bench. That bench took the same view. It was somewhere in 2015 Jan or something. Somehow I said, no, my lord, this is a phenomenal research is required. No, 10, 11 years. What type of order this tribunal has written? I cannot even. You have to give time to research, my lord. Your lordship have to trust me. I will do research and you can post it. Again, it didn't surface for quite some time. Somewhere in the month of November 2016, it surfaced before third combination. Third combination was absolutely saying, I will not give you even a second. This matter has to definitely be reversed. Nothing doing, that's it. Somehow I still requested, oh my lord, lot of research. No, I am not giving. Then I told him my famous statement of my mentor. My lord, looks like even stars are conspiring against me, not getting an adjournment in this court. I have argued so many matters, all I am seeking indulgence for a small adjournment of 2 weeks. And today stars are also not with me. What can I do, my lord? If your lordship have to close the case, that is the fate of the case. I have nothing else more to say. The judge was a little comfortable with such humor in the court and said, okay, last chance. I am not going to give it to you beyond 18th of December because that's when the roster will change. So I am posting it on 17th December for its finality and I already made up my mind. You will not be allowed to argue more than 5 minutes. I said, yes, my lord. There's horoscope for this case that what will happen. Then on 17th, he didn't surface at all. So he was a little perplexed. I asked you that case, why it has not come? Court officer, why that matter has not come? What is the number, Shankar? No, my lord, it came yesterday. What, it came yesterday? Yes, my lord, it came yesterday. Your lordship were very pleased to dismiss the department. I dismissed the department appeal yesterday? Yes, my lord, very much. Your lordship may see the number is there in yesterday's cost list. What happened? Why did I dismiss it? No, my lord, department only withdrew it because monetary limits had become so much higher. Under the monetary limits, that case didn't survive. So both the years it got away. So we saved about 80-90 lakhs of interest and some 36 lakhs of taxes, and the interest from 2005 to 2016. All that, then he immediately said, I think your client must pay you a lot of money, not for arguing the matter, for taking adjournments. Thank you, gentlemen.
Sir, before I want just one thing to Shankar sir to also, I'm sorry I keep Surya sir waiting, but very important point. In his remarks, Shankar sir mentioned about short term for the building and long term for the land which the landowner gets in a area sharing agreement. He said, you'll get, your land is already there with you always. You get some 50 flats. You would have already contracted to sell them. Within 3 months, you're selling all the flats. So be careful and ensure that you bifurcate the consideration in your apartments to land and building, because land will be long term and building will be short term. Now, this is an adventurous view, a mischievous view, and definitely a view which is eminently possible in my opinion, where we can take a view that where the development agreement is entered in a particular year, we have an area sharing allocation agreement which is entered after the plan sanction, which is maybe 9 months after the development agreement. In that area sharing agreement, you clearly decide which are the number of flats, in which floor the landowner is going to get it and which floor the developer is going to get it. Therefore, the apartments are identified. The right to receive these apartments has started in the date of the allocation agreement. Therefore, even when I sell that apartment after 4 years, when I actually get possession, the date of holding should go back from the date of right to receive, because even a right to receive itself is a capital asset. And I can definitely look at Sanjeev Lal, Shaila Motilal and so many cases where the Supreme Court has also held that, for example, the date of paying the first advance for a property or the date of giving 1,000 rupees as an advance with an agreement is the date on which your capital asset starts. So this view, I want Shankar sir's opinion.
I didn't get your view at all.
My view is from the date of an allocation agreement, which is normally entered within 30 days of plan sanction, which may happen within 9 months from the date of development agreement. We have clearly identified which are the apartments which are going to the owner, which are the apartments which are going to the developer. Therefore, my right to receive those built up area starts from that particular date. So when I give up that right 4 years later, when I've actually got the apartments, that can also be long term, that should not be short term. Based on Shaila Motilal, Sambandha, Uday Kumar, so many decisions which have now come in our favor, that the right of a capital asset commences from the date on which you make an advance or have an agreement. It need not wait for the actual possession of that capital asset. That is what is my mind.
Your view of a right in an agreement is also a capital asset is a very interesting proposition. It has support from two interesting decisions, the Bombay High Court in what decision known as Vijay Flexible Containers and Tata Tele, and the Karnataka High Court, if memory is right, in one case called Chandrakant Sanu, which I had the opportunity to argue. The point is, the moment you take right to get the flat itself is a right. You have to be extremely careful for the simple reason, you will get away if you are given on joint development a building, then you lose your right on 54, because a right to an agreement will come under 54F. You have to evaluate that point first before you take a call. Second is, that right is a capital, that right is not foregone. Invariably, you will find all documents that are entered into by way of the landowner's share being sold are absolute sale deed. No prospective purchaser or bank will ever look into a consideration trifurcated. I am only bifurcation, your thinking is trifurcation by saying, I want to sell land, I have a right, that right I am saying, and then last my possession right I am giving. Possession is admittedly 9 points in law. That's how the law has evolved in civil, which probably Surya can clarify much better on the civil front. So one possession is 9 point in law. How will you bifurcate the consideration which you are receiving in respect of sale of one property to land portion, right to get an agreement portion, and later the actual flat portion? Probably will be a practical difficulty, though we can test at an appropriate case, provided the document contemplates a situation like that. Thank you.
I'm glad Shankar sir has not dismissed my thought process. At least said that you have got something to talk about. Now, since Surya sir is going to take the mic, I am also asking him to dwell upon the same fact. In a property, there are bundle of rights. You have an easement right, you have a mortgage right, you have a possessory right, you have a ownership right, etc., etc. My question is not bifurcation of consideration. My question was, from when does the capital asset start for a landowner? So if he can sort of throw more light on that and support my view that I could possibly take the date of the allocation agreement, I would be highly grateful to you, sir.
No, we have to, when it comes to taxation and, working, is it? Yeah. When it comes to taxation and the land laws, I mean, the context in which the land laws are understood is completely different from how it is understood under the tax laws, because we are dealing with the definition of transfer. There's a definition of transfer which is slightly in variance with what transfer is under the Transfer of Property Act, and we are dealing with rights and the definition of capital asset, which includes extinguishment of rights and other things which may not necessarily be there under the Transfer of Property Act. So yes, I mean, ultimately we will have to go by what the Income Tax Act, the provisions, the definitions say, and yeah, I mean, if as long as we can take an argument basis the definition, I mean, there are judgments under capital asset, under the definition of capital asset and transfer. The High Courts have taken both the views. There are High Court decisions taking both the views. There is no finality really to such. It all depends on how ultimately how the agreement is worded. So everything goes by what the intention of the parties is, and which can be only discerned from the agreement.
So last question for the day before we wind up. This is to Surya sir. Now when I want to reopen my assessment beyond 3 years and up to 10 years, beyond 3 years when I go, so there is one section, peculiar section, 149(1)(a), which it will give you how many years can I reopen the case beyond 3 years. And as you know, there are three types of, one is asset, one is expenditure, and one is entry in the books of account. And minimum income which should have escaped assessment is around 50 lakhs. So here the issues I want to raise is asset, expenditure in relation to an event or occasion, or it is the entry or entries in books of account. But when I go to 149(1)(a), what it says is, it has conveniently, they have ignored the word entry or entry in books. It only talks about asset or expenditure in relation to an event or occasion. Now the amendment made in 149(1)(a) thereby is, beyond 3 years when I want to reopen, suppose my every year, suppose asset here 10 lakhs, next year it is 20 lakhs, next year 30 lakhs. So 3 years together will go beyond 50 lakhs. So 50 lakhs will I have to see in 1 year, or I can take a period of 3 years. Similarly, expenditure is 25 lakhs, asset is 30 lakhs. So can I total that both, what the officer will propose to do? Total that and 50 years. And then how many years cases he can reopen? Only for those years. So like this we have some issues. And what about 68 to 69D with respect to this income, sir?
So this amendment to the insertion of subsection 1A to section 149 appears to be, if you see the language of subsection 1A, it appears to be to get over what exactly the example Mr. Naveen has given. If first to understand 1A, we have to understand what 1B says. 149(1)(b) basically, an officer has power to reopen for extended period of 10 years. If he has in his possession, books of accounts, documents or evidence which reveal that income chargeable to tax has escaped assessment. Earlier, up to first 1 year, it was only an asset. The income was supposed to be in the form of an asset. That has been expanded simultaneously with this 22 amendment to also include not just an asset, but also expenditure in respect of a transaction or expenditure in relation to an occasion or an event. And also, it has brought in a books of entry or entries into the fold for invoking the extended period of 10 years. Now, if you read 149(1)(b) literally, virtually everything gets covered. So there is no difference really. If literal meaning is given to 149(1)(b), there is no difference really between information which is required to invoke the 3 years period or the information which is required to invoke the 10-year period, because virtually within the meaning of an asset, expenditure and books of entries, virtually everything falls. But is that the meaning to be given? It cannot be, because these three aspects, that is asset, expenditure and books of entries, entries in books of account, are preceded by the officer having in his possession books of accounts, documents or evidence which reveal that income has escaped assessment. So that's how you have to read it. So according to me, the meaning that has to be given is that 149(1)(b) strictly applies to cases where some income has been concealed because of the use of the word reveal. If you go back to the 1922 Act, it used to have a word disclose. At that time, the court said because the provision used the word disclose, the extended period of which was at that time I think 8 years, could be invoked only if there was concealment or if there was undisclosed income. So that's how we have to understand 149(1)(b). Now, what has 149(1)(b) apart from these three had a threshold that up to this can be done only if the income escaping assessment is 50 lakhs or any of these three items represent 50 lakhs. Now, my understanding when I first this provision came was that the department or the revenue didn't want to reopen assessments beyond this limit, because 50 lakhs is a very small amount. They didn't want to, they wanted to not reopen cases where the amount is just 50 lakhs. But by way of this amendment to insertion of section 1A and the language used therein, what seems to have been done is that if over the period of 10 years, let an asset is generated and each of the years you have invested 5,000 rupees into that asset, all 10 years can be reopened. That's what the meaning of the reading of subsection 1A suggests. Now, what is the intention of this? Because on one hand, you say that we will reopen, we will invoke the extended period only if the income escaping assessment is beyond 50 lakhs. That seems to be a benefit really given to the SC. But you are taking away, giving that benefit and taking it away by inserting this 1A, virtually saying that I'll reopen 10 years, because once reopened, the assessing officer can go into anything else, because explanation to section 147 is very clear. Once reopening is done, the assessing officer has to do a fresh inquiry, a fresh assessment. He can virtually rake up any issues as long as, of course, it has not undergone scrutiny under the regular assessment. So this, according to me, is a very draconian provision which says, virtually on one hand taking away the benefit of this income less than 50 lakhs and also subjecting somebody to reassessment or reopening for multiple years because the investment made in an asset or the expenditure that is incurred for an event or an occasion over a period has been less than 50 lakhs. Now, but one thing that we will have to take advantage from this subsection 1A is, now 149(1)(b) really doesn't explain what an asset is. It only says income escaping assessment in the form of an asset. It only says income escaping assessment in the form of expenditure in respect of a transaction or in relation to an event or an occasion. But then 1A seems to clarify what that asset is. 1A seems to clarify what that expenditure is. If you read the language of section 1A very clearly, it says investment in such asset is what they want to bring to tax. It is the expenditure which is incurred. They have left out expenditure in respect of a transaction. They have kept only expenditure in respect of an occasion or event, which primarily goes to suggest your unexplained expenditure under 69C. So one good thing about 1A is the way it is worded. You can say that what is intended to be brought under the extended period under section 149(1)(b) is only an unexplained investment in an asset or an unexplained expenditure akin to section 69C or all those provisions 68, 69, A, B and C. It is only in those cases that these extended limitation can be invoked. That's something that perhaps we can, an advantage that we can draw. Otherwise, the provision that has been inserted basically takes away the benefit of 50 lakhs, which has been given not to reopen beyond 3 years. The power has been expanded. Like I said, even small amounts of investment in an asset over a period of 10 years, you get to reopen the entire 10 years. So this something I think will lead to a lot of further litigation, because there is some doubts as to how this provision needs to be implemented. Thank you.
So let me tell you the power of a chartered accountant or advocate. Because of the time shortage, else I would have taken you through various judgments argued by Shankar in his long innings as a advocate since 2001. Last Sunday, sir had the privilege to address 200 officers of the department from Central Circle Investigation Wing at a Chintin Shiver at Art of Living. The topic was whatever mistakes you make in course of search. So this Shankar sir was called upon to inform them, to deliberate, to teach them what are the mistakes we make during search and how to rectify them. Officers were assembled from Karnataka charge, Goa charge as well as Kerala charge. 2 hours non-stop, he spoke at Art of Living. Anyway, so coming to the... Anyway, sir, so I thank all my panel members for, moment, when the chairman had told me to do a panel discussion. So I had these persons in mind and I went and called them, each of them, even before, in a jiffy, in a second, they told that we are ready. And Ashok Raghavan sir gave me time. I went to his office. We had a very good discussion, 1.5 hours, 2 hours on a Sunday. Then Shankar sir yesterday, he called me. He told, I am a senior advocate. You have to come only 1 day before. I have no time. So when I went there, it was a pleasure sitting in KSCA in his cabin. He called me immediately. He finished a roundabout meeting with the 20-25 officers because, this tournament is there, Maharaja tournament. And then I was seeing him. He sat there and he was deliberating with them, 10 of them, and then again he got up, he went to the boardroom, he sat there for an hour or so, then he came out again, he apologized again, and then we went for a round in the KSCA. Because I saw some CA, when he came in, he was asking me, how's your health, sir? I told you, just take his phone and see the health now. The target is per day, I have to walk 33 kilometers. So I just took his phone yesterday, he showed me, last 7 days, it's reached 33 kilometers every day. That red line has reached 33 kilometers. Today, when you came here, it had reached 22.5 kilometers. Therefore, he told, let me walk. He went there and again came back. So to reach his target, and now he'll be going to KSC again. And definitely, he'll take 2 more rounds and finish his target. I thank all my panelists. And I would like to apologize to Surya sir also. We could not have enough time. Sandwich between 2 stalwarts. And then, therefore, we have decided next time we will have only 1 topic. And instead of having 3-4 topics, and we'll give equal time to all the panelists. Thank you very much.
He thinks the best when he walks. So tap him when he walks and he will give a perfect answer.
It was a feast listening to these stalwarts. Your expertise has truly enriched our knowledge, sir.
I now request CACR Davalagi, past Chairman Hubli branch of SIRC of ICAI, to present a memento to our moderator and our panelists as a token of appreciation and gratitude.
CA Naveen Khariwal ji, who moderated the session wonderfully. I request sir to present a memento to CA Shankar, Senior Advocate. CAT Suryanarayana, Senior Advocate. A huge round of applause. And to CA Ashok Raghavan, sir. Thank you so much for this wonderful session, sir.